I really think we're still at very early innings of this 10 to 20 year shift where mining is cool again.
Gradually over time, it will happen, and we're banking on that change. We're banking on this reindustrialization.
But we're saying this as an asset class be more investable in the US.
Welcome back to Rockstock Channel. It is Thursday, May 28th, and today's discussion is going to be a little different from many of our prior conversations around lithium, rare earths, and critical minerals. Over the last few years, we've spent a lot of time on this channel identifying specific companies, projects, and commodity themes before they became widely appreciated. Whether that was the niche but now mainstream lithium in Argentina, Quebec, Brazil, or Nevada, or cesium, or seafloor mining, or phosphate for the LFP supply chain, or more recently, rare earths and specialty metals tied to defense, AI, and industrial policy. One thing we've increasingly realized is that the critical minerals opportunity has become far broader and, frankly, far more complex than any one investor can realistically follow on their own. The USGS has labeled 60 minerals and materials as critical. Lithium has been the gateway drug for many investors, including myself, but as lithium has been both the best and worst performing commodity 4 times over the last decade, other parts of the commodity complex, whether it be gold, silver, copper, uranium, and a long list of esoteric and highly specialized materials like tungsten, antimony, high purity alumina, and the 17 different elements that fall under the category of rare earths, have also experienced their own volatility, both to the upside and downside. And that creates a real portfolio construction challenge. Most investors can't become experts simultaneously in lithium, scandium, niobium, gallium, and rare earths like NdPr, DyTb, yttrium, etc., while also tracking the geopolitics, industrial policy, permitting, or speculating which projects might be picked for financing deals coming from arms of the US, Canadian, Australian, or European entities. So today's interview is really about how investors already somewhat familiar with commodity equity investing in more traditional metals can access opportunities in these more niche materials. Joining me are Stuart Macliver and Tomasz Nadrowski of Amvest Capital and the Amvest Terraden Fund. Stuart is the founder of Amvest Capital, a New York-based merchant bank and investment platform focused on natural resources and critical minerals. Tomasz is the portfolio manager of the Amvest Terraden Fund and is also an author of the recently published book, Mineral War, which I strongly recommend viewers buy and read. You can do so on Amazon. We'll flash a picture up right now. Tomasz has spent decades investing across global mining and frontier resource markets, speaks 7 languages, and has developed one of the broadest geopolitical and critical minerals frameworks I've encountered in this sector. Tomasz has been on an extensive book tour for Mineral War and has done many podcasts, some of which I've linked in the show notes below and would encourage you to listen to for an overview of the topics covered in the book. I'd also encourage you to listen to Tomasz's own podcast, Tyranny Today, which will flash up here on the screen as well, and also linked to below. And finally, Tomasz writes prolifically on LinkedIn, where I saw he was recently visiting Lynas in Australia, one of the most strategically important non-Chinese rare earth supply chain companies in the world. And he also recently wrote a thoughtful post about Brazil's increasingly important geopolitical position between the US and China in the global competition for critical mineral supply chains. I'd encourage you to follow him on LinkedIn as well. Before we begin, I'd like to thank our new sponsor, Clean Elements, an investor group focused on providing growth capital for critical minerals developers focused on the energy transition. Clean Elements has invested over $30 million to date and is currently the largest shareholder of both Galan Lithium and Noah Lithium Brines, 2 companies developing high-grade lithium brine projects in Argentina. While reading Mineral War earlier this year, the thought that came to me is that Thomas really knows these commodities intimately. And equally importantly, he understands the strange capital markets dynamics that influence select companies on the ASX, TSX, or US exchanges. I thought to myself, if I were to invest in an actively managed hedge fund for exposure to these niche commodities, Terraden could be a good option. Today's conversation, though, is not intended as investment advice or a solicitation to invest in any fund or security. Any discussion of the Amvest Terraden Fund is for educational purposes and informational purposes only, and subject to all applicable compliance and regulatory considerations. This conversation is also not another discussion of his book, Mineral War, which again, I'd encourage you to listen to one or more of the interviews that Thomas has done recently, including with recent rockstockchannel guest, Henry Sanderson. But before getting into it with Thomas, Stuart, I'll start with you. We met around 2016 as you were starting Amvest. At that time, RK Equity didn't have a newsletter or a social media presence, and we were in a similar business to you. But we both knew well Tazo Arima and Ian Middlemas and their successful track records as venture capitalists in the junior mining space, plying their craft in North American markets. But why don't you start by telling our viewers about yourself, how Amvest has evolved, and what it does?
Yeah, thanks, Howard. Good to be on. And so, yeah, I'm from Perth, Australia originally. Background is in chartered accounting, or CPA as they call it in the US, with postgrad geology qualification. So I can definitely count my rocks. And then always wanted to live in New York. So I quit my job in Perth. I had one-way ticket in 2014, and now I'm still here. And yeah, met you then as well, Howard. And then Amvest I set up with my business partner, Gabe Alonso Mendoza, as a conduit for US investors to get exposure to the mining sector, whether that's on the broker dealer side that we have, which is road showing mining companies in the US, etc., or the fund we set up with Thomas in 2023. So depending on how people want to allocate to the sector, and it's interesting, coming from Australia, you can, with your online trading platform in Australia, you can buy any stock in the world. In the US, there are 250 online trading platforms, and only one, to my knowledge, can buy non-US securities. So there's definitely an audience here that is happy to buy ASX or TSX directly, but pretty much most of them, unless you're listed in the United States or have a US ticker, it's kind of hard to get the mainstream US retail into a story.
Okay. When you look at, Stuart, the level of U.S. investor understanding today around critical minerals, supply chains, geopolitics versus even 3 to 5 years ago, how much has changed and how much misunderstanding, still exists?
Yeah, it's definitely changed, and education is improving. I'll never forget, like when I moved here, people ask what I'm doing that I've met who are new to me, and I say I'm in mining, and they're like, "Oh, cool, you're in Bitcoin mining." I'm like, "No, I'm work in the mines that produce the products that you need to build your Bitcoin farms." But now with COVID supply chain issues, these conflicts, which have a lot of links to natural resource security as well, and the current and past administration in the US focusing on securing more of these minerals. The government and the US media is kind of doing the education for us that the three of us in this call have known our whole careers. So it definitely is improving, and people are aware of the importance of lithium or rare earths, and are kind of becoming more aware of the stranglehold that China has on the supply chain of many of these minerals.
But they're not very technically understanding of the minerals in the way that Australian investors can dig into a 43101 mine plan and PEA. They're still getting up to speed a lot. For sure. on that.
I have one good analogy of the improvement in the knowledge is when I was coming back in the country around a year ago. The guy, immigration, checking my green card, was like, "Oh, what do you do?" I was like, "Oh, work in mining." He's like, "Oh, cool. So rare earths?" I'm like, "Sure." yeah, rare earths. He's like, oh, PM Materials. I was like, no, it's MP Materials. Like, oh yeah, that company. He's like, I got my grandkids to buy that stock. And never have, in the 12 years I've been here, have you had some journalist US citizen actually aware of this stuff. You know, coming from Perth, you might talk about mining stocks with a taxi driver or someone in a cafe or whatever, but you know, that was the first time I've seen that here.
It's an interesting point you bring up, because my girlfriend and also my brother-in-law, you know, they're all like watching, you know, what I do and this, and then they, you know, and then they're seeing it on TV, right? And now they're, oh, your friend, or he does lithium, right, or critical minerals, right? I'm like, you know, should I buy Albemarle, or, you know, I want exposure to lithium, is it too late, you know? And I'm always, you know, very reluctant, right, to, there's asymmetric risk there, right? Like, you know, if it goes up, you don't get thanked very much. If it goes down, you know, you're blamed. But you know, I do often recommend to them, if they want certain exposure, like if it's nuclear, to just buy a uranium ETF, or in lithium, there's, you know, Sprott LITP and other things. But I own a lot of these ETFs outside of lithium because I know it so well, and in rare earths. But yeah, I do own a copper ETF, COPX. I do own uranium, URNM. But I looked at, you know, when I was thinking about this interview and looking at, but if I really wanted to get exposure to scandium or yttrium and other things, you know, let's talk about Amvest Terraden, because you are benchmarked to this VanEx REMX, which you know, has Albemarle in it, and it has MP Materials, and it has like a bunch of different things. But it's not really like, if I wanted esoteric minerals, it's not a good vehicle, you know, for me. So I guess, Stuart, why you have a 3-year track record now, Stuart and Thomas, you have a 3-year track record. That's typically a magic number, you know, in the fund strategy, you know, raising process. But I guess, why did you start the fund? And if you could talk about what's its approach, and what are, just like, as a vehicle for someone who is prospectively interested. Again, this is not a solicitation, but like, how is it different from, you know, buying an ETF?
It's a good question, because, you know, in the mining sector, there's probably 9,000 globally traded mining equities to choose from. So there's a lot of filtering has to go in place. And, you know, I actually met Thomas. We were both living in New York, but I met him in Western Australia on a lithium mine site tour for Mount Catlin. You might remember that one, Howard. And, you know, stayed in touch. I recognized his name badge. And then, you know, we'd have always wanted to get into the funds management world, and, you know, working with Thomas was a good stepping stone. His old employer, a family office in the US, was one of the initial LPs, and so it made sense to, you know, combine forces and set this up together and see where the story, you know, takes us. And, you know, for us, we definitely look at commodity first, and then, unlike some of the ETFs, you know, we back out China exposure in the supply chain. And then we also are happy to go down the food chain. You know, some of, you know, in the US, $1 billion company is a nano cap, whereas in Australia, that's like a mid cap. And so, you know, we're happy to go in that food chain. And I think the 30 largest mining companies combined is like 1/3 of Apple's market cap. So for some Americans who are buying the Magnificent Seven, they look at this sector thinking it's just minuscule. So, but that's kind of how we live and breathe. And you know, we also go visit projects. We're off to Portugal next week to visit a tungsten project, and then off to Macedonia to see an antimony project as well. So you definitely have to go and check the projects out as well.
Let me just jump in to also try and answer Howard's question, because Stuart mentioned 2 things which I'm going to put into the sort of overarching structure of the fund and what we're trying to do. So very early on, we decided that this fund will not invest in anything that's somehow China related, by offtake, by securities, by financing, and so on. That excluded, by nature, a lot of legacy producers. As we know, you know, for 30 years of globalization, the global mining industry depended on the Chinese market. So we decided to basically turn the process around. Rather than looking for project X, project Y, project C, and then figure out whether it's valuable in itself, we're not running away from geopolitics of that sector. We start at the geopolitical level. What are the materials that are the most constrained on the supply side, which is an important contributor to their criticality. We're talking critical minerals. Once we know that, and that's easy to ascertain thanks to the restrictions that China imposed on some of those, we decide, okay, where are the industrial bottlenecks, and where in the value chain are those holes that need to be filled with the pricing power selected throughout that value chain. If it's upstream, then we go into our bread and butter, mining, development, exploration. And very often, because of what I mentioned before, it's non-cash generating producers yet, because of the nature of bifurcation between the two worlds that really is the story of the 2020s, right? So older companies continue to sell, say, lithium from Pilgangoora to China, not investable for us. And once we have that, then we proceed, on a fundamental basis. But it's important to understand that in some of these materials, it is extremely difficult to find exposure to those minor metals through mining. Why is that? Well, as we all know, they're often produced as byproducts of larger metals, right? Bismuth comes with lead, indium and germanium come with zinc, gallium with alumina refining, tellurium with electrolytic copper. And so if you ever discussed anything with smelters, then you find out that they're gonna skin the cat, just like they're gonna pay you 35% for cobalt mined with nickel. For some of these smaller materials, it is less than that. So the entire value is at the refining stage, not at the mining stage. This might change in future as we're paying so much more attention to these minerals, but at the moment, often you have to look at opportunities a little further down the value chain, towards even the determination of what the components, alloys, and compounds are created there. And that's important because that's the other side of the criticality. Why are they critical? Because of changing nature of demand. I learned my ropes in mining industry in gold in South Africa, and we never really had to, be worried about the market. The gold market was there, and we did a lot of nice things, marketing gold jewelry in India, with beautiful models and pageants and so on. But that didn't really move the needle. It's still an investment product more than a jewelry product. But other than that, we were the only company that dealt with the market challenges. Here, you constantly have to pay attention to what's happening in the market, because the third area of that criticality is substitution risk. And we want to believe that this is not just a substitution risk, it's also substitution opportunity. And so you have to follow the technological changes downstream and how this changes both in the civilian and military market can affect future demand for some of these materials. So in a way, it's an approach just slightly different from our traditional, investment, this copper project, that copper project, this iron ore project, that iron project. You have to pay attention to the entire value chain, how it's being rebuilt in the West to secure our economic security going forward.
Okay, very helpful color. Did I hear you say it has to be completely outside of China, even from the purchasing of material perspective? Can you invest in a miner that's generating their revenue from China?
No,
Okay.
We don't.
Spodumene names, that leaves a door open for explorers and developers who don't have offtakes yet. But if, they were to sign an offtake once they're doing, the construction decision, then that would mean we have to get rid of it.
Okay,
well,
so that's it.
Obviously, you're pointing something important, Howard, here. I mean, where are the, Western converters, right, of spodumene? Because that's the bottleneck here. Who's going to develop that value chain? So it's an important question for the current developers, where this product's going to go once they get closer to production.
It's very interesting, because there's a number of companies that we have on our podcast, right, or we talk about, like, let's say, Core Lithium, right? They were running a process. We didn't know how they were going to fully fund their business. And it turns out they chose to go a completely ex-China route from a financing point of view, with Glencore in the mix and Nabari. But the reality is, like, Glencore is going to be selling that product into China, right?
Yeah, you got to look at that. Like we saw at a tungsten, was it tungsten? Yeah, in Tasmania had an offtake, I think it's a couple of years ago with Traxxas, and then we also heard that that Traxxas will then be passing it on to China. It's like the only option back then. So you have to do a bit of digging.
So like what happens there, like, and lithium ionic, they just signed offtake with Chinese counterparties. So like, could you have been invested in lithium ionic, but as soon as that happens, you say, okay, I need to sell it, and in the case of Core, it's not 100% clear that Glencore is going to be, marketing it into China. So like, it's a very, I could understand a strategy where, if it's partnered with Ganfeng, or some other Chinese party, not okay. But, a lot of these markets, the reality is for a period of time, I guess MP was uninvestable for a period, when they had Chinese involvement, but as soon as they signed the deal with the US, then it became investable for you.
It's the best example, actually. This is the best example of what we mean by bifurcation of the two worlds. So if a commodity decides, like lithium ionic, that they're on the Chinese side of the wall, that's too bad. Maybe other people invest in this. We won't, by definition. But there are certain companies that are in transition. I'll give you an example from what you mentioned, my recent visit to Lynas. Lynas still sells something to China. Most of that is actually selling to Japan, delivery address to China. But it's still there. It's a legacy position. But its strategy is to completely wind it down to zero over the next 2 or 3 years. And therefore, that commitment on which side of the divide is giving the reality of mining today is just as important to us. So we cannot change the world overnight, and I don't think our government will be able to, or anybody else in that sphere, because the downstream is doing what it's doing and purchasing material from China. But gradually over time, it will happen. And we're banking on that change. We're banking on this reindustrialization. And maybe lithium converters will be part of this reindustrialization, as would be, graphite spheronization or SX separation of rare earths elements.
Okay, so you guys you're structured as a hedge fund, and hedge fund marketing and the like has very strict compliance restrictions. So there's a lot of information that we can't actually discuss in this public domain. But if you're interested, any of our viewers, if you're interested in further details about the Amvest Terraden Fund, please, you can email me at rockstockchannel@rkequity.com, and I can connect you to Stuart and to Thomas. This is also something that if you're a Patreon sponsor of ours on the $150 and $250 a month tier, for which we have regular quarterly calls, we could discuss this in greater detail as well. But what we can say, Stuart and Thomas, you have now a little over a 3-year track record, I think, or is that right?
Just under, but yeah, getting close to that.
Okay, just under 3 years. Your benchmark is the VanEck REMX index or fund, and you have substantially outperformed that since inception, with the strategy that you just articulated, right? This ex-China strategy, but also you're able to, if I look at REMX, like I said, it's invested in Albemarle and MP Materials, some Chinese groups, generally larger liquid producing names. Your fund can go earlier stage, can go smaller, invest sometimes in private placements where there are warrants attached, or in some cases have, private companies. Is that correct? I mean, like, how should you view portfolio construction? How many stocks do you own?
Yeah, so for us, it's definitely commodity first. What commodity you want exposure to? Can you even find a proxy in the equities? So say high purity quartz, we cannot. There's one mine in the US privately owned, and niobium. There's 3 niobium mines in the world. So there are a few more up and coming stories, but we go from exploration, development, production, try and have decent exposure to both those three buckets. That can change in the interest rate cycle. High interest rate environment, the companies that are at construction decision have a lot of project finance, tend to not do as well as producing companies or companies far away from cash flow, like the early stage explorers. And our average market cap's probably 700 million US, but that's slowly growing as the sector, as more money comes into the sector and the tide is rising. And then, we do pre-IPOs, some privates, as long as there's an avenue to going public. Can't stay private forever. And we actually see some more opportunities of late in some commodities. Say tungsten, the well-known US-listed tungsten name, just did so well. It made sense to kind of roll some of that into some earlier stage promising companies. Some of those are private, going public this year.
It's actually interesting, just if I can jump in, the story of tungsten up until 2 or 3 weeks ago, the best performing metal of the previous 12 months, is quite remarkable because of a differential way in which that very different assumption going forward about the floor of the price translates into equity valuations. It actually differs quite radically between different operators and developers and explorers. By and large, however, what we have not yet seen is the overall conversion of the changes, the regulatory changes, not least the signaling that the US government sent last year with the MP Materials deal, into valuations of critical mineral companies and more broadly. So it does seem that in some of these subsectors, they're still valued on the basis of Chinese prices, so Asian metal prices, which, however, are not sustainable because they wouldn't incentivize investment in any of these projects. So, the CEO of Lynas, she's very adamant saying that the floor prices should be offered to these materials among all of the allied nations outside of China. So that investment really flows into this space. Right now, we haven't seen it yet, but it's a massive structural opportunity in this space. Once the recognition of that transformational change sort of percolates into equity valuations, and it's going to be a step change in terms of the investability of these companies and their size, and therefore liquidity and everything comes with us.
But what's interesting here, I've been here 12 years and you'd probably want to be a 500, 750 million US valuation before you would have considered listing in the New York or the NASDAQ. And that threshold's definitely come down, in my opinion. And we're seeing more and more companies do direct, either dual listings, and like Rare Earth Americas is the first company in a long, long time in the exploration phase. I think it's the first mining exploration company in a significant amount of time that's just done a fresh IPO onto a US exchange. Typically it's a Canadian or Aussie company doing a dual listing. So that was quite unique, but we're seeing this as an asset class be more investable in the US. Mining, some people consider it still dirty, but it's the lifeblood of human existence. If it's not mined, it's grown. And, the S&P 500, around 1%, 2% is materials, but of that, 1% is mining equities. And there aren't many companies listed here. So we're slowly seeing that, more money come into the sector, whether that's through ETFs or actively managed funds or investors investing directly themselves.
You mentioned Rare Earths Americas, and that is a client of ours. And we just interviewed Don Swartz at the IPO. And yes, this is very unique. Like just as a broader thing, like people talk about the US capital markets, when Starbucks went public, it did so at a 250 million valuation. And now SpaceX is private, right, until it's a 2 trillion valuation, right? So the opportunity is, and this is how I've made my career, is that like at least the Canadian market, the Australian market, you could enter public early stage venture capital opportunities. They're pre-revenue, unlike Starbucks, but much earlier in their life cycle. So for a Rare Earths Americas, a group of Australians, for the most part, who typically would list something in Australia and then dual list, like they did with Piedmont, for example, because it's similar people behind that company, they just recognized, when Tesla signed an offtake agreement with Piedmont and, it traded $2 billion in one day, people recognize, oh, wow, the U.S. capital markets, we may not be so smart on mining, and it may be a very small portion of the S&P 500, but there's more money, like in Milwaukee and, Chicago, than there is in Melbourne and Sydney, right? Like the U.S. capital market is so huge and the country's so wealthy that, if you tap into it, you could have very substantial liquidity and better cost of capital for a number of players. And that's why Rare Earths Americas, the fact that they were able to take a a pre-revenue, early stage, pre-resource, collection of assets public at like a $300 or $400 million valuation and raise $70 million. This is not like some $3-4 million Aussie listing at 10 million market cap. Is exciting. It's interesting, and it was lead managed by Cantor Fitzgerald, right? And I think Canaccord, and Stifel and B. Riley. So it's good, and it's under the Trump administration as well, who has largely been supportive of deregulation and not only of permitting mines, and he's pro mining and pro processing, but also from a capital markets perspective, you're having more less regulation or more leniency, in the capital markets, and this is all great and creates good opportunities for ex-China. Your opportunity set is growing, I guess.
This is an interesting example, but we really relating here to U.S. assets, right? The problem starts when it's foreign companies with foreign assets. What can we do to use our very deep, liquid, efficient capital markets to reduce their cost of capital? That's a big question. Of course, one way is for them is to redomicile here, and it's possible for some, a bit expensive for others, but I don't think it's possible for the entire set of opportunities that are currently listed in Australia or Canada or elsewhere to just move and redomicile to the US. The market wouldn't be ready for that anyway. And so my question remains, why are we trying to solve that issue of reindustrialization, including upstream and midstream, and reacting through Department of Energy, Department of War, Department of Commerce? So far, Department of Treasury has not been really affected by this process. It would be maybe beneficial for critical minerals, for the economic security of the United States, to be supported by our tax system, whether it's for the US companies or whether for the companies of our allies, to which we are connected through Defense Production Act Title III, because Australian, Canadian, and UK material is considered domestic according to US legislation, and yet our tax system does not really recognize it. There's nothing that would incentivize you, Howard, or us to invest in those companies from a tax perspective, but we are incentivized in some states of this country for installing solar panels made in China, right? So there's some disconnect here, and I don't think that would be that complex if we actually tackled our existing tax treaties with our allies to actually solve it and help reduce their cost of equity first, and then even maybe cost of debt as well. Because otherwise, in many cases, as we notice over the arc of the 2020s, if not earlier, many of them are not necessarily very competitive for some assets, especially in those sort of frontier markets and some of the fence-sitting global south.
Yeah, it's interesting, like trying to educate generalist Americans on the mining sector is, this sector's been financed for a few hundred years from like the old joint stock corporations in London going on far-flung expeditions the other side of the world. That's how they finance these companies. So for some people here, a $10 million IPO is just considered completely crazy. But that's just how the whole exploration sector is financed in Canada, Australia, London. But for the right company, the right project, if it has a US angle, it should definitely consider listing here. There's won't name the names, but there's two companies we know. One has a US listing, one is only an ASX. And personally, I think the ASX company's market cap is capped. because it's just thinking from focus on Australian investors. Whereas if it was listed here, you might spend $2 million on the IPO and you could add 500 million, $1 billion of market cap. It's a pretty good return on investment, if you ask me.
Actually, we know a couple of such pairs between the US and Australia in antimony and tungsten and rare earths and so on. And so there is a gap, which, it's understandable given the relative sizes of the capital markets. But just coming back to that US exposure to overseas mining investments, I started my mining career at Anglo American's gold and uranium division. Forget gold and uranium and division for now and think about the name Anglo American. Why was it called Anglo American? Not because where it was down in Johannesburg. It was because the capital came from UK and US. Back then, 100 years ago, US investors were investing in what turned to be Africa's largest company for many decades to come within radius of Johannesburg that represented 12% of African GDP. Capital for this came from America and UK. So it was possible to do this. For some reason, that's not the story of recent decades.
To Thomas, I have a mantra now. It's kind of go long where memories are short. And it's only really been the last 30 years that, you've had this anti-mining mentality in America. So one of the biggest corporations, I mentioned, kind of Milwaukee area, but Minnesota, 3M, Post-it notes. That stands for Minnesota Mining and Manufacturing. Right. So the iron mines that supported, our auto industry, we have, just like Anglo American, we have a very proud history and we have great resources here in the United States. And that's why Xi Jinping, rattling his saber, rare earth saber one time too many last year, really woke up. Scott Bessent said, we were asleep at the switch for the past 20 years. And now you are having this whole of government approach. It started under Biden, but it was under Green New Deal, and environmental justice and other, hoops that you had to kind of go through. But you now have, it's more, and it was very much, kind of battery and electric vehicles and green energy, et cetera. But now it's military, it's defense, it's AI, it's reshoring, it's processing, baby processing, and mine, maybe mine. So I really think we're still at very early innings of this, 10 to 20 year shift where mining is cool again, and process and manufacturing is cool. But you mentioned something it's relevant, Stuart, because you're Australian, you're sitting here in New York. A lot of Australians, they know the process to get listed in Australia, and you do need to think big, right? In America, I used to have I'll flash up on the screen here. I used to have in my office, a Snoopy, with a football or whatever, and it was a sign, think big, right? So the Australians need to think big, because the typical IPO, or RTO in Australia is it's 20 cents, right? 20 million bucks, right? And you could articulate a path to 200 million market cap relatively easily. But after that, right, much harder, right? So think big. You gotta, whenever we represent a company, whenever I see an early stage company, I said, okay, what's your path to $1 billion, right? Because we saw that with Tazo Arima's Coal Spur, and we saw it with Piedmont, and we saw it with Brazil Rare Earths and Hyperion X.
But the pathway to $1 billion, I think some people, it's we need to raise 10 million, or we can just raise that in Perth, Sydney, Melbourne. Why do we need to go offshore? Well, I think if you have a long-term plan to actually build the mine or get the company to $1 billion plus market cap, then you've got to come over here a few times a year and go to Europe a few times a year, presenting the story to companies and get to know you. There aren't really many punters in the US capital markets who want to put something in a 10 mil valuation and get out of it 150 mil valuation. They'd rather come in and see a fully baked or fairly baked 500 mil de-risk opportunity and see it go to $1 billion. And that's just their risk appetite here.
This is interesting. this is also interesting because you're talking about this threshold of 200 million, maybe a little more sometimes. Many juniors in Australia or Canada in the past didn't have to bother because there was another exit through corporate activity. Some of this corporate activity was assured by the presence of, say, for example, Chinese companies, right? They would pick up a lot of assets throughout the 2010s, not least many lithium operations in South America, which were under Western companies. I think Australians still remember Norilsk Nickel's $6 billion acquisition of a nickel junior, right? So there were these exits of that sort. The problem started, of course, with the war in Ukraine and basically cutting out Russian and then Chinese companies from at least critical minerals space. Maybe it's different for gold, and in a way kept the opportunity for that sort of early exit that would multiply that 200 million with some sort of a premium from foreign entities of concern, as we call them here in the US. And because of some of these sectors are being relatively orphaned by large potential consolidators in the West that would buy rather than build within those subsectors, well, the consolidation is just taking much longer. So many of these companies will have to actually slog all the way to the finishing line at some point, unless there's a catalytic change in terms of the structure of these industries in the West.
There's a lot of Australians, we call them Crocodile Dundees, that came to America or North America. A lot of them are in Quebec, and they are listed in Australia or listed on the TSX. But the first of, among those, look, you can get to a very large market cap with an ASX listing. I mean, Fortescue has shown that, Lynas has shown that, Pilbara has shown that, but you've needed to attract the U.S. capital. And all of those companies have aggressively, kind of come to America to finance those aspirations. But now the U.S. is just more welcoming in a U.S. listing. You do have to put your big boy pants on. It is a bit more expensive, and your directors and officers insurance is more expensive, et cetera. But it just many U.S. investors will just not invest in a 5-letter ticker that ends in Y or F, even if it's on the OTCQX. Having the full blown listing makes a big difference. So, Thomas, you mentioned tungsten, and this is one of the things that bugs me, and Scandium. Like, we used to represent, Sunrise Metals back in the day, when it was a cobalt nickel story with a Scandium optionality. And then I made some money, 7 or 8 years ago, but I didn't make 2,400% last year as Scandium, went through the roof. And likewise, I was involved with Almonte and Tungsten, 14 years ago at its IPO at $1, and it languished there below that for 12 years or 13 years. And I thought to myself, tungsten is important for military, but there was no killer app like there was for lithium, being the battery, right? Being a step function on the demand side for tungsten. And then I started getting like a sniff that maybe I should look at Almonte again. And I didn't buy it. Right. So I'm frustrated by that, but you can't watch everything. So like Scandium and Tungsten. And now I spoke to someone yesterday. They interviewed us, and they were in DC a week or two ago. The Northern Miner put on some event, and he said, everyone was talking tungsten. Tell me about tungsten. I'm like, it's kind of like a sign that, like, and there's been a bunch of new listings of tungsten stories. Like, I'm looking at this carefully now that, so do you still see opportunities in tungsten? You said you made a lot of money on one and exited. What do you like in the portfolio, across the critical mineral space, Thomas?
Okay, so let me just first go back to your experience, frustrating experience of sitting on something that didn't move for a decade. And it goes back to our approach. Why were we interested in tungsten at the right time? Because we itemize every single Chinese export restriction. And of these, there were 24 between export control of 2020 and the meeting in Busan last year between Xi Jinping and Trump in October. 24. Several of those affected tungsten. So weaponization of tungsten wouldn't matter if it wasn't for the monopolization of tungsten, because these are two different things. Monopoly is one thing, weaponization is another. As you know, South Africa used to be a monopoly in platinum. It didn't bother anybody, right? They just bought it from South Africa to use in ICE engines as a like converter. The same with niobium, controlled by Brazil, doesn't bother anybody. But when monopoly is weaponized, it's a different story. And tungsten on our list is number 4 in terms of the most controlled metals by the PRC, after gallium, heavier earths, and ceranized graphite. 82% of production. And so for as long as these restrictions were not in place, nobody cared. Now that monopoly is being weaponized. Now suddenly it mattered. Scandium is a little different story. There's been scandium production out of different flows. It's not necessarily a metal, as you rightly pointed out in the case of Sunrise, that comes with other lanthanides as a rare earth deposit. Can be extracted from titanium, iron ore, alumina, for a lot of places, and there used to be production in the Philippines and Ukraine and other places, and much of this production died over time. And suddenly, it's a very important element in drone technology for long-range drones for solid-state batteries. So, sorry, not battery, fuel cells, and so we have those two cases of criticality that we mentioned before. One is on the supply side, the other one is on the demand side. Something structural has changed about the demand for scandium, and something structural has changed in terms of our Western availability of tungsten. And now you're asking, of course, the question, how long is going to last? I wish I knew the future. I don't.
And that's like, for us, we're seeing in this high commodity price environment, so I use tungsten example because it is, very highly priced. So many more projects get dusted off the shelf because they look good on an MPV basis. You put it in a new high price, and you kind of be careful. People go, "Oh, I've got this great tungsten project. It's been sitting on a shelf for 20 years, but now I'm taking it to market." Like, there's got to be some red flags. So, we're careful. It means we have to look to scour through more opportunities to find the good ones in these situations, but it can pay off by getting the right ones.
Yeah, I mean, that's one of the reasons why some of the supposedly low-hanging fruits are being approached. Some of these are brownfields development, some of these are tailings reclaiming, and some of these are, for example, past producing mines, underground mines. But if an underground mine didn't work in a different price environment, it's not an automatic guarantee that it will function in this one, because historically, maybe with different labor costs, it was run by some sort of narrow vein chasing, resuing, or something like that. If you want to do it in a modern way with bulk underground mining, you better check the country rock and how competent it is to do a different mining before actually start counting your operating margin for that. So not everything that looks like a low-hanging fruit is technically a low-hanging fruit despite higher prices. Just a word of caution.
Let's just wrap up in 5 minutes, and we'll have you guys on the podcast again, and we could talk about different commodities that you like. I did want to treat this as just an introduction to Amvest and its business of assisting Australian, for the most part, but also Canadian companies, access U.S. investors and U.S. capital markets, and also the Terraden Fund, which is a very unique, kind of proposition. But Tomasz, just to close on two recent posts you had on LinkedIn. One was your visit to Lynas, and the other was, the Brazil, geopolitical balancing act. If you can just share your views on that.
Yeah, the Malaysian trip was extremely just invested me a lot of optimism. I actually held in my hands terbium oxide, dysprosium oxide, samarium oxide for the Western market. Okay, let's call it.
Yeah.
Let's call it what it is, Japan, but it's part of the Western market, right? Because the Japanese going to use it to make sintered magnets that we will need, right? So it is part of our Western value chain. It's very exciting. Brazil, as I kind of raised it in my recent posting, I have some concerns there because I think the current administration under the current and former president wanted to see another return of a super cycle, which we all remember, right? The first decade of the 21st century, and suddenly Brazil, Petrobras, and Vale, and everything just went through the roof. We are in a very different environment. China is not growing like it used to, and in fact, it has used Brazil as a source of pure commodities while flooding it with industrial goods, in a way, underpricing and destroying many different industries, of which the one that I pay attention to is chemical industry. Because without this good chemical industry and reagents for mining, it's going to be much more expensive to mine in Brazil. If you can no longer release resources from the state of Sao Paulo, and you have to really all import it from Ningbo in China, then it's a different structure. But that's what's exactly happening. It's been happening, and it seems to me that finally Brasilia is getting the hang of what's happening and is starting to protect its chemical industry against this onslaught, which is not unique to Brazil. The same thing is happening, so-called China Shock V2 in Turkey and Southeast Asia and all over Africa, wherever we had industrial facilities. And it's very difficult, and it's going to be difficult to mine in those areas if you're so dependent on reagents that come from China. The same about equipment. Mining industry has to learn how to become a little less dependent on cheap Chinese equipment. And that's one of the lessons that I also brought from Malaysia.
Okay. And just going back to Malaysia, what you mentioned was in your hand. Those were heavy rare earths, not light rare earths. That's why you were emphasizing it, because MP makes the lights, but heavies is where the prices are much higher and it's much more scarce. And we're kind of like 100%, or maybe slightly less than that, dependent on China. So it's very meaningful. And Amanda at Lynas, it's a difficult process to make these heavy rare earths. So could you comment, Thomas, because I think Matt, who's not here, just wrote his most recent blog was about, this thrifting of heavy rare earths. I think MP Materials commented that, the price differential won't be so much, for the heavies. So if you could just comment on your thoughts about heavy rare earths, because this is also where Rare Earths Americas is focused.
Yeah, we could have another hour about it. So it's it is an important piece of that, and I spent quite a bit of time with the COO, the French COO of Lynas, talking about it, because as you know, in mining we have to make a capital decision way ahead of time, right? It's long period with rare earths, with the 16 elements, 14 lanthanides, 2 non-lanthanides, yttrium and scandium, and 1 non-existing one. So people count as 17. It's always a choice. What am I going to actually optimize first the ore body for, so that I don't lose maybe potential to extract something else in future, and especially the plant, say an SX plant, which is mostly the case. It's difficult. Right now, the focus is on dysprosium and terbium and samarium for samarium cobalt magnets, different use for aerospace and military applications. But it is true that there are now attempts to avoid doping of sintered magnets with dysprosium, which is so scarce. And Proterial, so former Hitachi, is at the forefront of those attempts. There will be products which will avoid doping. Now, does it mean that dysprosium won't be needed suddenly? That doesn't mean that. You need it still for ceramic capacitors. You'll need it for many other applications and semiconductor production. But the question is, so what's this next thing? Is gadolinium the next thing, right? For example, for electromagnetic warfare, after all the missiles that we used in the Middle East. Maybe, and nobody's extracting this. Nobody's actually separating gadolinium today. But are we is anybody gonna take this risk, this financial and capex risk right now, to build a separate line to produce gadolinium today, if it's to deliver a product in 5 or 6 years from now and the market will be different? This is a very, very difficult question. It's more difficult than if you run just, a copper mine. And there is no one answer to this. But it's true that substitution risk in critical minerals is something that you have to constantly watch out for. Luckily enough, we are mostly in liquid markets, so our job is not as difficult as the job of a COO of Lynas.
Okay. Thank you very much for that, Thomas. I hope our viewers got a flavor for the depth of your knowledge of these esoteric commodities. And as I mentioned, you didn't miss tungsten, and I think you didn't miss Scandium. So for those investors who don't want to miss things, the Amvest Terraden, could be an interesting vehicle for you. Again, if you want more information about that, please reach out to me at rockstockchannel at rkequity.com, and I can connect you to Stuart and Tomasz. So thanks very much, both of you, for sharing your knowledge here with us, and look forward to following up with you in the near future.
Thank you,
Yeah,
Howard.
thanks, Howard.